So the 30,000, excuse the ignorance, was that the down payment or the purchase price?
That was purchase price, 30,200.
Oh, I was afraid you were going to say that.
30,200. I remember the 200.
Oh my God.
For sure we'd be eating hot dogs and baked beans the rest of our lives.
You know, one of the claims to fame that you have is investing over 6 different decades, which I love to think about because there's been a ton of different market cycles through that. And we initially met over with the real estate guys at their investor summit in Summit on Sand. And that's where we first met. I was very interested in your story just because you've got a lot of history and you don't focus on one asset class. And so I was hoping we could dive into some of that experience. But before we do that, maybe give us a little bit more background on where you started, how you got started, and what your story has been.
So I asked my wife one night, my new bride, the name of Ouija, said, what do you think about going to California? She said, okay. So out we came, did a high-tech career while my first company, Fairchild, found my first rental property for me to rent. And I showed up and the landlord lived next door. He had no college education. He was 38 years old. He owned several houses on the street and he was financially independent. So that was what we call an aha moment. Right? So he encouraged me to consider that. And I did, against better opinion. So most people told me that they thought that prices had gone up so much in the 50s and 60s, they couldn't imagine it go up anymore, and they thought it was a bad investment. So we took the big risk after all, and my wife's hand was shaking while we signed the docs for $30,200 for our first rental house, and it was rented for $350. So that's about 1.1% per month. So that was actually possible in Silicon Valley and San Francisco Bay Area at one time.
Wow. Yeah. Well, it's amazing what perspective will give you, right? Like you think back then 30,000 and people were saying, or the naysayers were saying, hey, this can't go up any higher. It's been booming 50s and 60s. And you guys are really nervous, but in hindsight, it's like, oh my gosh, how could you think anything different? But when you're in the moment, it is very different.
And one day I thought, you know what? Those houses that I bought in the 70s are earning more for me while I'm sleeping than my high-tech job and stock options are while I'm working. So I segued over to just sell my own properties in California and exchange them into properties in somewhere else. Studied the country for over a year. Dallas-Fort Worth came out on top. One of the 2 fastest growing projected at that time, which it still is, major economies in North America. And so we had friends who turned us on to some of their team down there, and we started exchanging properties. So I sold first house here into 13 duplexes in DFW, exchanged the second house with one tenant into a 64 unit apartment house in Fort Worth.
Wow.
And away we went. And then so I was accumulating houses and duplexes and fourplexes and apartment houses. So, there are a lot of contrarian things that I did. First of all, leaving the region and coming to a totally different region. Nobody in my high school class went off, something that risky, adventuresome. Buying houses, rental properties when people said, no, it was too late. Don't do that. Going out of state when it wasn't popular yet to do that. So, I think techies do pretty well in investing. They tend to take the emotion out of it, and they run the numbers. But you've also got to be not too risk adverse. You got to be able to, when you walk past some open doors, you got to walk through some of them, not all of them, but you got to take some risk and accept that you're going to have some failures and learn from those and add it to your repertoire of of experiences and skill sets, and keep moving forward. So I've had some failures, but it's been a net positive. Also, in 2001, I bought a apartment house that to convert, actually townhomes, that was a classic condo conversion project potential. It got, like all secrets, once they get discovered, they're not good anymore. At that time, condo conversion was a pretty valuable thing to do. I didn't plan to do it. My broker said, "Tom, I know this isn't what you're looking for, but I found something that's I think is a really good potential, and I'd be delighted to be engaged with you on this project." So we bought a bunch of complex of townhouses that were separately deeded and could be sold off individually. So we rehabbed them and sold them and tried to sell them off locally. Couldn't get renters. I thought for sure a third of them would go to the local renters. Nope. Sent out 10,000 postcards to everybody renting in the area. Hey, you can own for less than you can rent.
Wow.
Had 17 responses. I know 3 went under contract and they all fell out. So I thought, what the heck? And people, so you really gotta understand and accept, I think, that different regions and different markets have different cultures and mindsets, and you can't expect that whatever has been true here and wherever you've been investing or wherever you live is necessarily how people think and operate someplace else. It's
Sure.
just like, if there's any single thing that I've learned over the years that's most important, is that the market is thousands of submarkets, if not 10,000s, and you just can't broad brush anything. You can't broad brush that, gee, because Amazon comes on, all retail is going to be scraping the face of the earth. Nope, there's plenty of stuff that Amazon can't compete with, and so forth. And as an analogy, so in some regions, renters are renters; they'll never be buyers, no matter how well you pencil it out. So I thought, well, shoot, I think my investor and techie buddies back in Northern Cal would see the value of this. So that's when I started marketing in 2000. I guess end of 2001, 2002. So that's really when my Wilson Investment Properties got started in 2020 years ago. And sure enough, they saw the numbers worked. It worked as a rental property. They were trying, a lot of those folks were considering buying in, Bay Area, but the rent in DFW at the time was triple per invested dollar. What is here? Triple. It's like, first time that was shown to me, it's like, no, obviously I'm not getting the math here. Something's wrong. I got to calculate this again. It was true. So we proceeded to for the next 10 years to flip 600 houses in DFW to investors across the country, and mostly in California. And it was used my engineering kind of a skill set to set up systems and how to analyze what financial numbers would make sense. What color paint, what kind of carpet, how much rehab to do, how much not to do, all of that, set up all those formulas. And I've always had the approach of, like most techies, I tend to micromanage a bit in the beginning, but the difference is that I was taught early on the power of delegating. So once I feel the team is on board and they understand the formula, I feel like I can trust their competence and character, then I back off and turn them loose. So that worked well. I had people at times look at my giant, looked like a stockbroker there at my desk with all these screens across, looking at all the information going on every day. It's six employees, and we, occasionally I'd have a visitor and say, "Well, Tom, this is amazing. You got this spreadsheet with 230 pieces of data on it, and for each property that you've got an offer on or a contract or in the middle of rehab, is up for sale, contract, all this." And said, "Do you ever get up in the morning and you see a property on here that you didn't even know that you owned?" I was like, all of them come that way. I don't know. Now, in the early days, I'd fly down. I'd look at it myself.
Yeah.
But once the team, so I think that applies to any business that you do, right? Yeah, you gotta be really, really engaged in the beginning to make sure that you can have confidence in the people and the formula. But you can't scale without delegating. You gotta really delegate to others, give them the power, give them accountability. Otherwise, you can't scale. It's just they say that's probably the primary failure of most small businesses is somebody has really good skill sets at something, but they don't have management skills. They don't have business skills sufficiently, and they can't scale because they can't let go of being the one that's right on the scene.
Yeah.
I'm delighted to let go after a while. I hate doing the same thing many, many times over and over again. So we've now done 24 syndications. Initially I started DFW, but to diversify in risk and for our investors and myself, and to find enough deal flow. That's another problem. You can say, well, I'm going to focus on self-storage between $5 and $10 million in on the east side of Dallas, and with this kind of cap rate, and you'll eventually probably find it, but you're not going to get a lot of deal flow. Yeah. So to get spread risk and to get more deal flow, we started going into other asset classes and other markets across the country. So we've been in 12 different markets, done 24 syndications, pretty equally divided in between the 4 major asset classes and commercial. And remember, commercial's root word is commerce. So it means anything that you invest in, which is for the purpose of commerce, of earning money. So houses aren't considered that, because the primary purpose of houses is owner occupant. We turned it into an asset class, and there's a certain percent of them that are owned for that purpose, but that's not their main purpose. Whereas a multifamily is only for revenue. An office building is only for revenue, and so forth. So we had so the 4 major classes are multifamily, which everybody's familiar with, just somewhat, usually office, retail, and industrial. And each of those have their own subset. Let's look at industrial, for example. Most people think immediately, the Amazon warehouses where you're distributing stuff. Yeah, that's one sector, warehousing and distribution. But there's, there are others like manufacturing.
What have you seen like between those 4 asset classes, let's say within commercial real estate? Well, I guess let's take a step back. Let's talk, maybe give us some insight, because you made a transition between the single family investments, which were pretty significant. You'd mentioned over 600 at one point that you had flipped. So maybe single family versus commercial real estate, kind of pros and cons, and what made you shift that way?
Yield.
Okay.
Houses. I think there's some advantages of houses. You have a distributed risk, which I think has value, both because you don't have tenants on top of one another that can influence each other negatively. Because you're in different submarkets, around either the MSA or around, different parts of the country. Yeah. One mistake I think some people make is maybe you can certainly over diversify too. I remember, having people come up to me at different investment clubs and say, "Tom, I just want to thank you for encouraging me. Last year or so, I now have 7 properties." And I think, well, wow, that's great. I'm so happy to hear that. Where are they? Well, I got one in Miami, and I got one in Fort Worth, and I got one in Boise, Idaho, and I got it's like, isn't that a little hard to manage? You got to talk to 7 different property managers. So I think there's a certain amount of quantity in a certain area is valuable, because then you can get you have less managers to manage, and you can get the property manager's attention a little bit more. Yeah. But so there's a couple of advantages. They tend to appreciate more. Houses do, as even before this this crazy run up we've had lately. They tend to appreciate more, but only if you catch it on the upside, right? There's only one way you know where the peak is. That's after the peak. And then people tend to catch a falling knife and it goes. So it's great while it's going up. It's great if you get the timing right. But that is, if you don't really have cash flow at an 80% loan, which the coastal cities have not for a long time, in the Northeast and California, then you're gambling on appreciation. So I prefer having a more confidence in cash flow, and then appreciation is a bonus.
Yeah,
not everybody agrees with that philosophy. That's what's worked for me. Because as you know, Chad, if appreciation or if house prices go up and down, as long as you got cash flow and you can hang on to the property, then your risk is not very high.
Yeah.
In the 2008 crash, I didn't lose any of my properties, and none of my investors lost any properties. Some of them had to sell a few to take the good money and cover, bad properties in places that crashed. So anyway, as the foreclosure market happened and the hedge funds came in to swoop them up, then the yields went down because the funds were willing to pay a higher price and take lower yields than most of us investors. And then better than that is multifamily, but multifamily is considered by many to be the lowest risk of commercial. I don't necessarily agree, but then the other asset classes of office, retail, and industrial tend to have a little bit higher cap rates on the average than multifamily do.
What about when you're looking at let's say between the four main commercial real estate asset classes you referred to, when you're deciding between those four, are you still primarily just looking at yield, or are you looking at some other variables as well on your purchasing decisions?
Oh, sure. It's got to have a certain yield. So it's always a trade-off, right? You want a yield that's good enough to be able to raise the money to do. If it's very high, if the yield is very high, which is very hard to find these days, you can pretty well figure it's coming with some higher risk. If you can handle those risks, then that's okay. But no, you want you want it to cash flow well now, but you want it in a market that's growing. So you're looking at the economics of the area. How broad-based is the economy? Is it a one-horse town, or does it have multiple economic bases? If it's commercial, what kind of industry or business are the tenants in? How competitive are they in that marketplace? What's the projection for that for the industry that they are in? Mm-hmm. What's the age of the building? How many potential surprises are there? We just walked away from a building that we really liked everything about it, but in the end, it was we thought there was too much risk on taking on the bones of this historic building, which was a trophy product. And so no, there's a huge amount of variables and metrics we look at other than just yield. It's got to have a certain amount of yield to satisfy investors. Mm-hmm. I mean, basically, we keep surveying our investors and ask them, what do you want? And most of the time they say, well, we'd like this kind of yield, but we'd be willing to take on a little more risk to get a little more yield in this area or that. And in the end, I can't emphasize this enough on why investors invest. Often we'll ask, well, why did you invest in this? Was it because of this product or this particular market or yield? What was it? And most of the time they say, well, we mostly because we trust you. and you come across as genuine and transparent. You've had a great track record, and they're basically investing in you, right?
Yeah.
So that's really important. So no, there's a general growth of the area, the industry or economics that your tenants are in. If it's not a multifamily, the quality of the building and what risks come with it. What's the absorption rate in that area, as well? How much capex do you need to put in? How much value add can you give? And I tend to do more stabilized deals than value add. Most of the time, not all, but most of the time when I've done a significant value add, it has taken longer to achieve than what was projected. And this is projected by experts. So it's, don't underestimate the risk in being able to fix something that it's easy to say, well, they just had bad property management before,
Yeah.
Sometimes there are other fundamental factors that are affecting that. So it's underwriting, and you got to have a huge velocity of deal flow to be able to pick out the nuggets. One of my brokers last year had 300 deals come across his desk per day. Per day. Now, obviously, he's got a team, and it's 99% is instant delete because he knows the source and or doesn't fit this or that. But you got to have a pretty, especially in a normal market, much less this seller's market now, where I'd say a third of our deals we get pocket deals. They haven't hit the market, and somebody calls up because they know we're closers. So knowing, having a track record of performing, being able to close is a big asset.
Sure.
So a third of them, I'd say, would be we lose something, and then whatever buyer they went into contract with doesn't perform, and then they come back to us, and then maybe a third is open market. But like everything in business and in the world, there's nothing more valuable than relationships, outstanding partners, relationships with people that feed product to you, relationships with investors. It's like any good business. It's a relationship business.
Yeah. Are you invested in all four of those commercial real estate assets? Mm-hmm. Which one's your favorite right now?
I can't pick one over the other. I've had excellent performance in all of them. You mean as far as what to buy right now?
Yeah, like what are you really bullish on right now? Yeah, from the buy side.
I'm bullish on anything that meets all that criteria.
You're still looking across all four asset classes to find
absolutely
those nuggets.
In multiple markets. So we've probably have been in this overheated market. It's harder to find them in primary markets, but secondary and tertiary markets are okay as long as they're not singular economy, which I call one horse towns. So you don't want to be at the mercy of going to build a multifam in North Dakota because they just struck oil, and then whoops, it's all nothing there.
Well, since you've seen a bunch of market cycles over the years, and you just briefly mentioned it being an overheated market right now, what kind of like market indicators are you looking for that help guide you in deciding what to buy or when to buy? Because like you said, you need to have deal flow. You're continuously buying. You have investors that want to invest money. So what indicators do you look at from a macroeconomic standpoint to help guide you?
Well, certainly inflation rate and projected interest rates for loans, and what's your projection for recession. I kind of thought we'd be slowing down by now 2 or 3 years ago. And of course, the pandemic at first. I think I have a copy here of Wall Street Journal, that at the beginning of the pandemic had a headline on it that some journalists predicted that commercial real estate would collapse and there'd be foreclosures all over the place.
Mm.
So you got to be very careful, and you got to be very, and one would think an article in Wall Street Journal probably has some substantial credibility, which I think for the most part they do.
Yeah.
But you got to be very careful in following the advice of sources that have a lot of power. Bernanke, before the 8 crash, made a statement that he thought, everything would be fine and that real estate would survive well and that would, that we didn't have any serious problem. Calvin Coolidge, before the 29 crash, made a State of the Union address where he said, I think everything's just fine. And so you got to be careful. If you're in business, you're in the crystal ball business, whether you like it or not. And you've got to make decisions based upon, just as you're indicating, where things are going, where the puck is going to be.
Yeah, yeah.
And it's so I'm kind of thinking sometime latter next year we'll start into a recession. So I think if that happens, then it'll cool off the seller's market and it might turn into a bit of a buyer's market. Yeah. But in the meantime, the problem is that everybody's a lot of people are sitting on a lot of money because we've had all this, asset growth, whether you're considered to be, real or intangible or not. And they don't want to just sit in cash because it's being, the value's going down with this inflation. But it's certainly safer than going to throw it into something that's, about to collapse. But people want to deploy money and they want to get some kind of yields. So, the kinds of things that we like and are looking at more, say, single tenant with 15-year leases, which I've done, in an economy or in an economic sector that has good, strong growth potential, regardless of what the business cycle is. Mm-hmm. We had one that was manufacturing air and water filtration equipment with a 15-year lease. They'd been around for 50 some years. And, so, are you in trouble if they go dark? Yeah, absolutely. But, I felt the risk was pretty low. So I'd say right now, we certainly watch all the economic factors that everyone else does, like the inflation predictions and the CPI and prediction of the what's going to happen with interest rates, because that certainly affects things. Mm. And the affordability index, as you know, Bruce Norris was probably the first one to popularize that back in the post '89 crash. We certainly look at that. In California, we're still up in the upper 20s, I think, in the affordability index. And the last 2 times we had a downturn in California, it hit down to 17 2 cycles ago, and it hit 12 before the '08 crash. Mm. So, you look at that, doesn't mean that single metric is going to predict everything, but it's, and I stay in touch with, I stay in pretty close contact following 5 of 6 folks that I follow. I know personally who are economists, whether they're self-made or professional economists, and like Peter Schiff and Bruce Norris and Dr. Doug Duncan and others. One of the things they have, John Malden. One of the things they have in Robert Campbell. They have in common is that they've all predicted the last cycles well, they're probably the minority of 5% of all the economists out there. And they were contrarians. They're like, I don't care what everybody's saying. This doesn't make sense. Mm. They might be off in timing a little bit, but I've always said I think real estate's the best get rich slow scheme there is. It's when people try to get rich fast, they get in trouble.
Yeah. So are you adjusting any of your underwriting or purchasing strategies now or in the near future with the thought that maybe things might start cooling off next year?
Yeah, when I think once you find a potential product that you want to go to the next level of underwriting, which of course you got to do very fast because people aren't going to wait around. The buyers aren't going to wait around long. I think is the when you underwrite it, the doing the financial analysis of whether a product makes sense. The one of the most responsible and difficult things to do is picking the assumptions. You can go on the same product, you can make an IRR come out at 10 or 20 just by varying the exit cap rate, right? And so there's a zillion different variables, and it's a lot of work.
Yeah.
So you asked about how do I adjust your lead question there, and that is, we're assuming that we will when we exit, a typical hold is 5 years, typical hold period. And we're going to assume that our exit cap is not as low as it is now.
Gotcha.
I think we're going to get some adjustment of that. They can't stay this low. That's what makes it hard right now to pick asset classes and other things. Is that before this kind of crazy run up, say back post 2008 crash, we'd have you go between different markets and different asset classes across the country. And, you could have cap rates of 14 with some asset class and markets and cap rates of 7, and others, 2-to-1 range. Now we have so much cap compression with all markets, all asset classes. There's not as much difference between them. So it makes it even now. I thought I'd never touch California again, other than say development, where you get a heavy lift because it's so hard to to lift anything in California for entitlement development. But we're looking at possibility just to spread our net, even California now, because we've had an exit from San Francisco, and the cap rates are so compressed that now there's not as big a variation between here and Miami. So it's so I'd say that's probably the biggest variable. I would guess occupancies are going to be down a little bit in future. We always go pretty conservative on our underwriting on what occupancies. We usually pick a number for the model, which is less than what we think we can achieve. You of course got to factor in what you think the loan rates are going to be. So I would think this is going to keep going up for a bit, but I don't know if we're going to get up to 6 or 7%. I think we'll get to a point where when the recession sets in, that now the Fed will worry about the economy. And maybe now they've raised it enough that now they've got some tools to try to raise it, to try to bring the economy back and bring the interest rates back down. So hey, when I started seriously, kind of full time into this investing, is back in what was that? I guess it was 90, 98, 99. I was just delighted to get my 8.5% loans. It's perfectly fine. It's all relative, right? No matter at any particular time, it's how is this investment compared to the other options I have? One of the normalizing factors is it's the same loan rates, roughly for anything that you get. So,
So during those cycles, so you've been investing in a bunch of different cycles. And a question I have for you in terms of if you could go back in time and maybe give some advice to an investor starting out, besides the old adage, the two best times to buy real estate are 20 years ago and today. Is there anything else that, like, what would you do different, or advice that you'd give to a new investor who's starting out today?
Well, I would say that one of the best things I did was to change my model, periodically, such as going out of state or going to a new market, going into new asset classes, switching from houses to commercial, going into other markets, things like that. I'd say the biggest mistake I made was probably not doing it fast enough. It's really hard, this for me, I think most people, it's really hard, I think, when something has been working, to walk away from it.
Yeah.
But but markets do change. Just because something worked before, don't just hang on to it in hopes you can push rope.
Yeah.
There are times when that comes. So that would certainly be one. I'd say, as far as timing goes, nothing more important than outstanding partners. And you got to get partners that are good enough you're comfortable delegating, because you can't scale unless you do that. Learn from your mistakes. When you have a failure, and you will, don't just run from it. Go, after you've licked your wounds there, go back and analyze it and think, okay, what did I learn from this? If I'm doing this again, what would I do different? Go add that to your repertoire of knowledge and skill sets to help guide you downstream.
Okay. Yeah, it's interesting. With CSQ Properties, we've been very active in investments in SoCal, and we're diversifying now out of California, still buying stuff in California, but expanding a bit more out of California. And we have a deal right now we're actually doing in Florida, Tallahassee, Florida, which is, the Tallahassee, it's capital, but it's arguably a secondary market. But the yields are great. So it's a big decision point, leaving, I guess, the comfort and security of beachside communities in SoCal, which weather pretty well, versus getting good current yield, cash on cash returns elsewhere. And it's that juxtaposition of deciding what to do. And like for me and my investors, I think there's a good balance, right? Like I get nervous when I'm too focused on SoCal, particularly with some of the legislative issues that we have, and liabilities from a legislative standpoint. But it's tough to beat the equity play that we get here. So I'm working on balancing that with out-of-state investments, and hoping that the diversity from a geographical standpoint will help weather some of these upcoming storms pretty well.
Mm-hmm. Yeah, I think having some diversity is good. And those that have focused on equity appreciation plays in the last few years have done well, more so and longer than I had guessed. But so I tend to prefer the cash flow as and have the equity or appreciation be a bonus. But if you these coastal areas tend to stay on pretty strong from a value standpoint. It's just that the cash flow is tough. It's like that's what I did in 98 when I went to Texas. Basically, you can't go back you can't go back in time where you are, but you effectively can by going to either a different product or different market or both.
Yeah.
So when I went into DFW in 98, I got the same rent ratio, the same income relative to the purchase price as I had 30 years before in Silicon Valley.
Yeah.
Yeah, they were running 1.1%.
Yeah.
So what happens is that, as prices appreciate, rents never appreciate in proportion. So the higher the price, the harder it is to get enough rent or revenue to cover your expenses.
Mm-hmm.
And your primary expense, of course, if you leverage traditionally, like investors do, your biggest expense is your debt service, and that's fixed by what price you pay. So that's the tough part.
Yeah.
That's the first. If you're looking for cash flow, that's the first number. If you're looking for appreciation, then you got to look at what's the population growth in the area, and look at these metrics that we talked about earlier in the macroeconomic field as to when are we going to have corrections and what's going to affect that and so forth.
Yeah. Yeah. Well, this has been great. Thanks for sharing all your advice and stories. If people wanted to get in touch with Wilson Investment Properties, what's the best way to get in touch with you guys?
You can email me directly at tom@wilsoninvest, WILSONINVEST.com, and I'll be glad to respond. I love helping others and being a sounding board and be a cheerleader. And
Yeah.
so I think it's a wonderful business. I love my 30-year high-tech career, and I've enjoyed this, 6-decade, partly on the side, but 24 years, I guess now, pretty much full time in this arena. Wow. So I'm delighted to help others, and we I think you're airing this just before the next summit at sea, so we're going to get a lot of our buddies down there. I think I better get some plane tickets here pretty soon.
Yeah, on the sand this time around, right?
On the sand. Yep.
You're gonna be there again?
Oh yeah. This will be I've been their 12th year in a row. I've known Russ and Robert, real estate guys, for 22 years now. Known Robert's dad met him 2 years before. He was the one that introduced me to his son Bob. Says, Robert. He said, he's doing some pretty good stuff, I think, in this low education arena. You might want to meet him. So
that's great. Yeah, I'll be there. I'm definitely looking forward to it again. It's an amazing all-star lineup they always bring, and the attendees are great as well. So I'm definitely looking forward to it.
Yeah, you don't find too many folks that are going to devote 8 or 9 days of their life and pay the ticket for something like that aren't pretty serious, and and for the most part pretty experienced. And it's I learn something from everybody I meet. And that's what that keeps me enjoying life and excited about this whole industry that we're in.
I like to say there's not a whole lot of tire kickers going to that investor summit.
No. Yeah, thanks so much for having me on. I've really enjoyed the discussion. And I appreciate the invitation.
Okay, well, thanks so much, Tom. We'll talk to you soon, and thanks for sharing all your time with us.
Okay, my pleasure.
All right.
Bye-bye.
Bye.